Welcome to the lecture on assessing interest and structured payments in loans. So, we discussed about the different methods, how we charge the proportion of the interest and the principal proportion when we talk about the loans, and we studied about the methods like level method and the another method which there was the increased value of interest, that is rule of 78 method. So, for 1 year you have rule of 78 method. So, based on that number of years maturity time, you will have rule of 78, or maybe for 2 years you will have rule of 300 or so. So, all that we have seen. Now, there may also be cases when you will have the premature payoff. Now, what we are going to discuss in this lecture, that we are going to discuss about the premature payoffs, and also when you have the payments of loans in the structured manner, then how it is to be represented, how they should be represented. That is what we are going to discuss in this lecture. So, many a times when we are talking about these loans, then there is a premature payoff, and somebody has to hand over, somebody has to prematurely pay off the loan. So, what will be what will be the consequences? What we see is that rule of 78, what we have seen, will allow him to give more interest at any time. If you look, suppose in a year he has after 6 months, if he feels that he should be he should prematurely pay off the loans, in that case he has paid more interest for the coming 6 months, for the past 6 months as compared to the level method. So, that can be basically calculated, and it can be seen that what will be the balance due in all these cases. Like if you talk about the level method. So, if suppose somebody is thinking of thinking of pay off the entire loan in 4 months, after 4 months, only after 4 payments, then what is due? So, if you talk about the level method, the due will be 133.33 into 8. So, that will be 1066.4 or so. Then if you talk about the interest, the interest how much he has paid, that will be 16 into 4, that is 64. So, that is what is the case of the level method. But if you go to the rule of 78, then in that case your balance due will be different. It will be 1600 minus the 4 times what he has paid, and he has paid basically less. So, if you calculate using the rule of 78 method, he will be having the balance due of about 1106 rupees. So, instead of 1066 rupees, he has to still have the principal portion of 1106 rupees, and certainly the interest he has paid more in those cases. So, that is how we see the calculation of these interest. And if you find the interest what he has paid in 4 times, in those cases we have seen that it is 12 by 78 into 192. So, it was 29.54 in your first month, similarly 27.08 in the second month, 24.62 in the third month, and 22.15. So, altogether you are paying the interest of 103.39 rupees instead of 64 rupees what you have paid as interest in the case of level method. So, if you look at the difference basically it will be 103.39 minus 64. So, about $40 or 40 rupees of extra interest you have paid in the 4 months using these rule of 78 methods. So, basically in that case you can see that you know these you are paying more interest by the rule of these 78 methods in such cases. There are methods to basically find the balance due. So, when you are paying prematurely the payment in the case of rule of 78, in that case suppose you have to find the number of unpaid in payments. So, if you have paid 4 payments, that will be 12 minus 4, that is 8. So, what is done is that normally you have dn as n into n plus 1 by 2. Similarly, you have du we get as nu into nu plus 1 by 2. So, in this case it will be 8 into 9 by 2, that is your 72. So, this is 36. So, what happens that the fraction of the interest on remaining payments. So, that is also known as rebate factor. Rebate factor is nothing but fraction of interest on remaining payments. So, this will be calculated using the formula. So, that will be rebate factor. So, that is RF, it will be nu into nu 1 plus 1 by 2 divided by n into n plus 1 by 2. So, it will be nothing but nu into nu plus 1 divided by n into n plus 1. So, what happens that if suppose in this case if you look at in this example, it will be 8 into 9 divided by 12 into 13. So, that way you will have 0.46154. So, the rebate what you get is rebate factor into interest paid. So, your rebate will be basically 0.46154, that is rebate factor, this is rebate factor into interest. So, that is 192 and it will be 88.61. So, this is how this rebate is being computed, and this is the amount of remaining interest which should not be paid, that is what the rebate is. So, if you calculate that interest, it will be coming as this one. This is nothing but interest, if you recall, in 4 months, using this rule of 78 method, you have paid the interest as interest paid is 103.39. So, that is what you have not paid 88.61. So, you are getting a rebate of 88.61 as interest. So, that is what you are calculating from here in such cases, and and from here you can get the balance amount due also. So, what you get is that you get the amount of interest which is to be from the remaining payments which is due. So, you have the formulas like T and U will be P by T into NU, and similarly you have balance due will be T and U minus rebate. So, this way you can calculate these balance due or other values using these rule in the case of the premature payments of the loans. Now, what we see is that when we talk about the different types of loans, then we have the interests which are assessed and the payments are structured in the different way, like you have single payment loans or add on interest loans or the different discount loans. Now, when we talk about the single payment loans, as we know that we are going to pay the principal plus the interest earned in a single payment, and in that case in case of the single payment loan, when we talk about single payment, we have already discussed that we have I is PRT and then PYT, the yearly the the payoff amount, it will be P of plus I. So, that is what singly you are going to pay it back. Now, there may be examples like somebody has borrowed rupees suppose 5,000 and you want to pay it back full at 6.5 interest after 2 years. So, in that case how much he has to pay? So, it will be suppose he has taken 5,000 multiplied by rate of interest, that is 0.065 into 2. So, it will be something like 650 rupees. So, 5,650 he has to pay back at the end of 2 years. So, in that way you can get what amount he has to pay. Now, there are things like the annual percentage interest. So, annual percentage interest, that is defined, and they are basically two types, one is stated and one is actual. So, when we talk about stated, it will be S and it will be APRA. Now, when we talk about the single payment loans, in those cases the annual payment annual percentage interest or rate interest rate basically. So, this will be same as the actual one, because if you look at this case, like you have P as 5,000 and R as 6.5% and N is your 2 years. So, I you got as 5,000 into 0.065 into 2. So, it will be 650. Now, if you look at this case, now in this case the stated annual percentage rate is 6.5%, and if you find the actual percentage rate also, annual percentage rate. So, he is basically paying 325 rupees every year as the interest amount. So, 325 he is paying for the 5,000. So, it is also 6.5%. So, in these cases of single payment, the annual percentage rate interest rate for the stated and for the actual case will be same. Now, when we talk about the different types of these loans, like you have add on interest loans. Now, this is another category of the interest loans, and they are add on as a method to calculate these interest rates. So, now in these cases what is happening, so most of the commercial banks and loan firms they basically use this method of add on loans, and what we do is normally in these cases the interest what is the assessed, and they are charged up front, and they are not basically received immediately. So, that is what the difference between them upfront. So, it will be calculated based on the whole principal and for the entire maturity time. Now, the whole interest basically will be added to the principal, and then total will be divided with the maturity time to determine the size of the periodic payments in these cases. So, in these cases what happens that your periodic payment will be P plus I upon N. So, so PYT is nothing but the periodic payment. P is the principal amount which is borrowed, N is the maturity time measured in equal intervals, like you can have the term these intervals as months, and I is the total interest. So, I basically you know that I will be PRT. So, you will have PYT as P plus you know I is as you know PRT upon you know or PRN you can say. So, PRN upon N. So, so that way P into 1 plus Rn by N. So, that way you will have the you know these periodic payment amount can be computed. Now, what you can say that if somebody has, so suppose somebody has taken the loan of suppose $6750 at 8.25% interest rate for 3 years. So, so based on the add on interest. So, in these cases find quarterly payment. Now, in such cases what happens that you have to find the I first. So, your PYT will be P into 1 plus Rn by N. Now, in these cases you know R will be you can have this is quarterly payment you have to find. So, you will have 12 payments. So, it will be P and this will be also by 4. So, 8.25 by 4 it will be 2.0625. So, R will be 0.20625. So, it will be 1 plus 0.0206 and then you will have 12 payments. So, it will be P into 1 plus Rn and then you will be dividing it by 12. So, if you take that P is being 6750, it will be you will be getting something close to 701.72 per quarter. So, this way you can have these you know periodic payment values can be calculated. Now, there is another type of loan that is your discount loan. Now, what is discount loan? We have also studied somewhat in our earlier lectures that in the case of the you know discount loan, the interest is assessed up front, but the entire you know interest basically will be deducted. So, in those cases it is not deducted, it is charged, but in these cases the entire interest is basically deducted and the rest amount will be you know borrower will be given the rest of the principal. So, so that way this is known as the discounted loan. So, in this case you know entire interest is deducted immediately from amount of loan sought. And borrower is given the rest of the principal. So, that is what the case is there in the case of you know discount loans, and then you have these rest amount will be basically divided you know in the equal payment mode, and then it will be divided by the maturity time. So, that way the interest which is you know rate which is there, this is known as discount rate in these cases, and the total interest which will be calculated is known as total discount, that is capital D, and actual amount received by the borrower is you know P naught. So, in these cases what we do is that you have in case of interest rate you have a discount rate. So, D will be P into D into N. So, this is the discount rate, and P naught will be actually P minus D. So, that is what you are getting p minus d, and this will be p minus p dn. So, it will be p minus into 1 minus dn. So, your periodic payment will be p into p by n. So, this will be your PYT. Now, what we see in these cases that basically he is not getting the the amount which he was supposed to get in these cases, and he is paying the interest. So, basically in these cases the actual annual percentage rate is different than the stated value, and for that the actual percentage rate in these cases are calculated by certain methods. Using first method, basically you calculate this method as 2 k I upon p into n plus 1. So, in this case k is the number of payments in a year. Then you have I as total interest, and p is the principal or original amount, and n is certainly the total number of payments throughout the maturity period. So, n will be number of payments during maturity period. So, basically based on that you can calculate the actual APR, annual percentage rate, which will be different than the stated, because you are deducting the interest upfront, and then you are giving that p naught, that is smaller than p. So, that way, and then PYT will be p by n. So, that also is there. So, based on that, so if you take the example of the earlier case of giving the loan of rupees 6750 for 3 years, in that case if you try to find the actual annual percentage rate. So, in those cases actual annual percentage rate using the first method will be basically 2 k I by p into n plus 1. So, now k is here you have so as we know that k is the number of payments within a year, and since you are doing quarterly payments, k will be 4. Now, I will be PRT. So, as we know I will be PRT. So, it will be 6750, R is known to us. So, R will be 0.0825 and it is for 3 years. So, it is coming as 1670.62. So, I we know, P we know that P it is 6750, and N we know that it is 3. Now, N is the number of payments. So, it will be 12. So, if you put all these values, 2 into k is 4, and then you have I as 1670.62 divided by 6750, and then you multiply it with 13. So, if you do that, it is coming as 0.152 or 15.2%. So, what we see is that the actual annual percentage rate differs from the stated percentage rate in these cases of the discount loans. And there are other methods also. There are second method also to calculate the APR. So, second method, in the second method we are further having another formula, and what we see that normally you have the different estimation of the APR, and it is larger than the stated APR what has been said, and that is why we can say that they overestimate the the interest. They are they are larger than the stated one, and so that is why they overestimate the interest charged. So, the second method, so that also you should know, the second method which is actual, which is being calculated, this is the second method, and this uses the formula k into 95n plus 9 into I and divided by 12n into n plus 1 into 4p plus I. So, this if you use this formula also, you can calculate the actual annual percentage rate, and k, as we know that it is 4, and then you have 95 into 12 plus 9, and then interest is 1670.62, and then further you have 12 into 12 into 13 into 4 into p. So, it is 4 into 4 6750. So, it will be calculated like 4 into 6750 and plus interest is 1670.62. So, this can be calculated, and this comes out to be 0.143 or 14.3%. So, from the first method you are getting 15.2% is the actual annual percentage rate. From the second method you are getting the actual annual percentage rate as 14.3%. So, these are basically the always larger than the stated percentage rate, stated annual percentage rate, and that is why they are said to overestimate the charges or the interest amount charged, they are overestimating it. So, this is the aspect which should be known to the persons who are into the business, into these who are subjected to such kind of transactions. When you take loan, you must know that what is the actual annual percentage rate you are giving, or you are subject your any of your loan which you are giving, what is that actual value that can be calculated using methods. And what we see that in these methods, since the interest charge is more, so that is how you want to assess, and you can compare the different offers or different options which is available with you. So, that is about these different structured payments of loans in a different way, and how. So, we will discuss more and more about other aspects in our coming lectures. Thank you very much.